It has certainly been, as they say, a November to remember. The Dow and S&P both up about 8% so far. The Dow adding rather spritily to its gains today, up 340 points. The Nasdaq up more than 10%. So will the climb continue, and are the numbers setting us up for a Santa Claus rally? Let's bring in Bryant VanCronkhite, portfolio manager with Allspring Global Investments. Bryant, did this move in the markets surprise you at all, and do you think it sustains into December and maybe even into next year?
I'm not that surprised by it, given the data we're seeing. The economy is slowing, but inflation's coming down nicely, and the Fed is orchestrating what they're trying to get done. They're trying to slow the economy down. But right now, this rally, as it continues into December, which I think it might, is really on the hopes of the Fed orchestrating a landing, but it seems to me that it's based more on a Christmas wish than on a 40-year-plus history of Fed inertia. They're typically very slow to react. They rarely preemptively do anything. And so I have to think that our base case is the Fed will achieve their goals. They're going to slow the economy. Companies will react accordingly by cutting CapEx, cutting jobs, and we're going to end up having to assume the Fed will be late in responding. So we might get this Christmas rally, but it makes me very fearful for what Q1 might have in store for us.
So you expect a marked economic slowdown, despite the fact that the third quarter numbers were just revised, I believe it was yesterday, to 5.2% gains for the GDP. This quarter, everybody says, is slowing down a good bit. So talk me through the next 6 months economically.
The next 6 months, I think, are going to see the impact of a long string of Fed tightening policy. So what we're going to see is consumer credit begin to weaken, consumer confidence slow down, spending alter their form. We're seeing trade down already with consumer behavior. From that, you'll start to see a demand for loans at the commercial level begin to slow, and companies will begin to pull back on their CapEx. That will then reduce the need for jobs, unemployment rises, and all of a sudden we have this cascading effect into a slowing economy that is already in the cake, so to speak. The idea that the Fed's going to all of a sudden cut that off right here when they still have some work to be done is just, I don't believe, something we've seen in history before. So my base case, again, is we're going to see that slowdown materialize. Companies will respond as they should, which will then catalyze the beginning of the bottoming process in 2024.
Keurig, Dr. Pepper, CBRE Group, Carlyle Companies. You like all these names in the mid-cap space?
I like all these names for a few different reasons. One, they all have defensive characteristics, either around some of their cash flow streams being very stable through this troughing process. But more importantly, each of them are doing things to drive their own destiny. This is one of the most important things we can do as investors today when the Fed probably won't be supportive to us overall. What are individual companies doing to drive their destiny? And so just pulling one out of that list, for example, Carlyle, ticker CSL, they're in the building product space. People think of them as being somewhat cyclical. The reality is their cash flows are pretty stable, as a lot of it's recurring revenue from replacement business. But they're in the middle of selling off their very final non-core asset, which will bring in about $2 to $2.5 billion of cash, moving them to a net cash balance sheet. As they recycle that cash flow into their core business, it will demand a higher multiple. But in the interim, that powerful balance sheet will protect us as investors if the economy does slide into a deeper recession than we all hope actually happens.
Interesting as that is a defensive play there. Bryant, thanks for joining us today. We appreciate your time.